Hello, my friends. Hey, it is John King, and I really appreciate y'all joining me here today to learn all about refinancing your loan for Dream for All. So the whole point of this, and I'm having an issue, but there is not a whole lot I can do about it. Let's see here. Nope, that's not going to work. All right, well, no big deal. Remove that. Cool. All right. So looks like I've got other people on here just fine. Perfect. Okay. So thank you everybody for joining me. We are here to talk about refinancing Dream for All. Anybody that is watching this likely already has a Dream for All loan, although I know some people who are very interested in getting Dream for All, but want to learn about what it's going to take to refinance down the road as interest rates look to be on a downward trend. So thank you everybody for joining me today. We're going to be covering a whole lot during this call. I plan on being here for an hour. I've got up to 90 minutes scheduled. If you can't stick around, you can come back and watch it recorded. This is all going to be recorded and streamed to my website. If you want more information, you can schedule time to talk to me. Scan the QR code right up there. I did have an issue this morning. I was trying the canirefi.com. I didn't redirect. So you got to put the www. So if you type it in, just go to www.canirefi.com and it'll take you to my page. If you scan the QR code, it'll work perfectly. And by the time you watch this recorded, the www thing will be fixed. But right now, if you just type in canirefi like it says, it won't work. Let's dive in, though, and let's talk about what I want to cover today. So first of all, good morning, Dominique. I see your comment on there. Thank you for joining me, everybody. So what's the point today? The point is, you guys are all first-time home buyers. You guys are doing this and you haven't gone through the home buying process before getting this home with Dream for All. And now the refinance process is all brand new to you. And I want to explain to you everything you need to know about how a refinance works in general. Then I want to explain to you how it works within Dream for All. And then I'm going to give you a tool. I've actually got an Excel spreadsheet that I have created that I will share with you. You just need to connect with me and I'll create the page with you. And then you'll leave that meeting with a copy of this spreadsheet. So if you want to get the spreadsheet, make sure to scan the QR code or type in www.canirefi.com and you can schedule a call with me and we will go through the whole spreadsheet with you and show you exactly what your numbers are going to look like. All right, so let's start with refinancing 101. There are only 3 reasons to refinance a home, and none of them are to lower your interest rate. You heard me right. None of the reasons to refinance your home are to lower your interest rate. A lower rate is just the mechanism that allows you to get one of these 3 things. Either lower your monthly payments, pay off your home faster, or pull cash out of your property. Those are the only 3 reasons that you refinance. And as a matter of fact, the 3rd reason, pulling cash out, is not an option when you have a Dream for All loan and you're trying to keep the Dream for All separate. But in the future, as you grow more equity, it is an option. Pulling cash out is the only reason you would refinance, even if rates have gone up. Okay. If you're looking to pay your loan off faster, don't ever let somebody convince you to refinance to shorten your term, even though your interest rate went up. That is always a bad idea because you can just pay extra on your current mortgage and keep your lower interest rate. So don't ever fall for the trick of, oh my gosh, I can refinance you from your 6.5 into a 15-year at 7%, and I'll save you all of these thousands of dollars in interest over the life of your loan by paying you off faster. But your payment's going to go up. And they'll say, oh, but it's a trade-off and it's worth it, but you can pay extra on your current mortgage. So if you're going to save money per month on your mortgage by itself without pulling cash out to consolidate other debt, then you need to have a lower interest rate. If you're trying to shorten your term, you need to have a lower interest rate. So if rates are higher or equivalent to where you are right now, you don't want to refinance. You can always just pay extra on the mortgage that you have right now. So that is refinancing 101. Do not let yourself fall victim to somebody saying, I can save you money by shortening your term. That only helps if they're actually lowering your interest rate, okay? So when you look at refinancing, a refinance is starting over on a brand new loan, okay? So you are doing a new mortgage. We are paying off the old loan that you have on the property. Now for you guys, you have 2 loans on the property. And so there becomes the question of, am I paying off both loans or am I paying off only one? Well, that's part of what we're going to talk about as we go forward. But you have this one-time chance to refinance your current first mortgage without paying off your second, but it's a one-time get out of jail free card. And so you've got to be cautious to say, when do I want to pull that trigger? Because the second time that you refinance, you have to pay off the dream for all. So I'm going to spend a lot of time talking about that. Okay. A refinance is not simply just lowering the rate on your current mortgage. It's a brand new mortgage. Therefore, you are starting over. Now, you don't have to start over at 30 years, but most of the time, it's the smarter thing to do. Most of the time, you've paid 1 or 2 or 3 years into the mortgage. You're not going to pay off this mortgage anyway. It's not like, oh my gosh, I just wish that I had only done a 27-year loan because here I am at 27 years and I'm ready to retire. And instead I have a 30-year mortgage and I have 3 more years into retirement. That's not typically the case. So don't get caught up too much, but you do have the option of refinancing and not doing it as a 30-year, depending upon the loan program. Okay, certain rules. And again, I got to be really cautious because there's lots of different ways you can go about getting a mortgage. But generally speaking, you don't have to start over with 30 years. But here's the key thing. It's a brand new mortgage. So all the fees that go along with doing a mortgage are due again. Yeah, they're due again. And you say, wait a second, John, I heard about these 0 fee refinances. That's very, very true. Except you're taking a higher interest rate than what you could have gotten otherwise. Let me give you a really, really simple example. The mortgage company says, all right, market rates right now, on average, Wall Street, who's buying these mortgages, wants to earn 6.5% as an example. Okay, so at 6.5%, Wall Street makes exactly what they plan on making, which means you have to pay for your title fees, your escrow fees, your appraisal fee, your underwriting and your processing fees. Now you said, wait, I don't want to pay any of those fees. And Wall Street says, great, then pay me 7% going forward, and I'll credit you for X amount of dollars of those fees. The thinking is Wall Street says, hey, I'm going to make 0.5% in interest extra every single year for the next 30 years. Now, they know you're not going to keep it for 30, but they know on average you keep a mortgage for about 5 years. So you say, well, then I'm going to make an extra 2.5% on this. And so if I hedge my bet a little bit, I'll give them 1.75% of their loan amount as a credit towards their fees. Now let's fast forward and let's pretend that we are 3 years down the road and rates are at 4%. Wall Street's going to say, hey, I can offer you a 4.5% interest rate with no fees because you're paying them 0.5% more than what they were willing to accept. So it's not 0.5% more, and it's not exactly 0.5%. I'm giving you a theory here, but you're paying a higher rate than what they want at that time. That's the opposite of buying down an interest rate, okay? It's called buying up an interest rate. You get a higher interest rate in exchange for less fees out of your pocket because Wall Street says, hey, if I'm making more money than I expected to make, I'm willing to write a check up front to cover their fees. Nothing is free. So when you see somebody talk about, hey, you can do a free refinance, it doesn't exist. When somebody says, hey, we don't charge any fees, you're paying a higher interest rate than you could have gotten otherwise. So now you have to factor all of that in. And that's where I'm going to be your guide. Okay, I'm going to help, just like I've been helping you all along, I'm going to be your guide to help decide, is this a good idea? I can run the numbers side by side to help you figure it out. I look at my role not as talking you into a refinance, but talking you through the refinance and helping you figure out if it's the right thing for you or not. I talk probably just as many people out of refinances as I talk into them because I'm looking at the math and saying, hey, it does or it doesn't make sense. Ultimately, it's your decision, but I'm not going to push you to do something that I wouldn't ask my brother or my mom to do. I'm looking at what I think is the best thing for you because I know, hey, if I tell you don't do it right now, your trust in me is significantly higher. When I do tell you a year from now it's time to do it, you're going to believe me because I told you today not to. And when you send your friends and family to me, you're going to tell them, hey, by the way, John talked me out of doing a loan. And so I trust him that if he says it's time to do the loan, you should do it. I built my career on that. And so you don't know whether it's true or not because I could just be saying that, but that is the truth. By the way, it looks like we have a question. Oh, thank you, Kathy. It wasn't a question, just a comment. Appreciate that very, very much. All right. So let's dive into a little bit more on the refinances. So first of all, when you look at your mortgage payment is your principal and interest, plus your taxes and your insurance. And if you have a homeowners association, it's on top of that. What I'm going to talk about and what you should always talk about when you're refinancing is what is the difference in principal and interest payment. I don't talk about taxes and insurance, and there's a really specific reason why, because we can hide things there. There are times when your taxes and insurance may have gone up because you were what's called negative in your escrow account and your taxes and insurance shot up. Well, I can compare your total payment and say, oh my gosh, I'm going to save you a bunch of money per month. But part of that is simply because your taxes and insurance are being reset to the proper dollar amount. That's not a fair apples to apples comparison. You will still likely be paying taxes and insurance in your payment. But when I'm comparing the before and after, I'm never comparing it, including taxes and insurance. Here's another reason why. Taxes in California go up every single year. Insurance typically goes up right now every single year. So if I'm comparing your mortgage payment now, including taxes and insurance, that includes what your taxes and insurance were last year. And yet the new loan I'm doing is based on what your taxes and insurance are going to be this coming year. Because once a year, you get an update, an escrow analysis that is done on your mortgage, and your payment changes a little bit to catch you up on the taxes and insurance of the current year. When you refinance, that's done automatically. But again, it's an unfair comparison because I'm saying, hey, I'm only saving you X amount of money per month. Well, part of that is because your taxes and insurance are higher than what is being currently collected on your current mortgage. So anytime you talk about refinancing, yes, taxes and insurance can and probably should be included in your mortgage payment, but it shouldn't be included in your calculation of whether it makes sense. So everything that I talk about does not include taxes and insurance when we're trying to decide, does this make sense? All right, I think I already covered this, how rates work on a refinance. There are a couple of things you need to be aware of. Fannie Mae, and you guys didn't see any of this when you were buying a home using Dream for All. But I'm going to share with you right now how Fannie Mae looks at risk. Okay, so there's a chart. I'm not going to go deep into it, but I want you to just get a basic idea of what this looks like. So let's share my screen. I'm going to go right here to this screen. Perfect, share. All right, so let's make this a better version of my layout. There we go. Beautiful. All right, so here is Fannie Mae's loan level price adjustment matrix. Very simply, Fannie Mae sets the risk saying, hey, how risky is this loan? Well, there's a table for purchase loans. There's a table for limited cash out. That's what you're doing. You're limited in your cash out, and this is what you're doing. Well, Fannie Mae says, hey, depending upon your credit score and depending upon your loan to value range, it can get way more expensive in interest rate and fee. This is an adjustment to fee. Now, you might say, John, CalHFA was fine with me. I got the same rate when I had a 680 credit score. Well, Fannie Mae doesn't think that. Fannie Mae says, hey, if you have a 680 credit score and you're borrowing 80% of the value of your home, you are paying an extra 2.25% in fee when you are refinancing. So you got to be really, really careful when you look at interest rates for a refinance because there's a lot built into the risk factors. One of the other things that's built in here is if you have subordinate financing. So you right now have a second mortgage with Dream for All. If you keep that second mortgage, you can, no problem. But Fannie Mae says you're a higher risk. So if I'm loaning you 80% of the value of your home and you have a second mortgage, then you are paying an extra 1.125% in fee for the interest rates or for the loan because you have a second mortgage. All right, got another question or comment here. Martino says, is Melrose included in those taxes? Yes. So when I talk about property taxes, your Melrose, which is typically when you're buying a new home, are included in your property taxes. Now remember, right now we're talking about refinancing. And when we're refinancing, your property taxes and your insurance are reset based upon the current tax and insurance amount. But when I'm comparing the two options, I'm ignoring the taxes and insurance. So I'm not using that in my tool. When you look at the calculator here in a few minutes, I'm not including that. Feel free, guys, to ask questions at any point. All right, so this thing here says you're paying an extra high fee for the fact that you have subordinate financing, that you have a second loan. So you're not going to get the best interest rates that are out there on the market. You also, depending upon your credit score, depending upon what your home is worth, you're going to pay more for the fact that your loan to value percentage. This is where CalHAFA's new program may make the most sense, because CalHAFA has a new refinance program. Now, the problem is CalHAFA's fees are a little bit higher, but when we compare, and I've run a few numbers side by side, I've got 3 ways that I can do a loan. I can do a loan internally through my company. I can broker it out to an outside company if somebody has their loans on sale. Every once in a while, there's a mortgage company out there that just says, hey, I'm giving away the farm and I don't care if I lose money. I just want to get as many loans as I can. And so if that's their thinking, I'll help them lose money and I'll send loans to them. Or I can send it to CalHAFA, which means I handle it internally, but the rate is determined by CalHAFA. Well, CalHAFA just came up with an interest rate. The problem is today's a holiday, but it came up with an interest rate for a refinance loan. In this case, it's a Dream for All refinance loan. And by the way, if you ever look on a weekend or a holiday, go down here to the bottom and click View Reports, and it pulls up a report, and it'll tell you what the interest rates were on the last day. And so if I go here, and Dream for All can, by the way, on a purchase, Dream for All is 6.375. On the Dream for All refinance, the rate is also 6.375. For most people, for the ones that I have looked at recently, this is the better deal when it comes to the interest rate and fee. But I'm always going to look at all of your options. I'm always going to compare to say, hey, should I do it in-house? Should I be a broker and send it to an outside company who's somebody we're partnered with that gives you a better deal? As a matter of fact, one of the companies that we partner with is Rocket Mortgage, who's the largest mortgage company in the nation. Now, we're typically right on par with where they're at. But every once in a while, they've got a special going. I'm happy to throw money at them for them to lose money on it if that's what they're choosing to do. So I'm always looking out for your best interest. But get it? Your best interest. See what I did there? Anyway, all right. So I'm always looking out for your best interest, no pun intended. And right now, the CalHAFA loan with the, maybe I'll make that bigger so you can see it, but the CalHAFA loan as the Dream for All refinance is probably your better deal, because CalHAFA is not nickel and diming all of these other adjustments. Now, if you have perfect credit, we may be better off doing a regular loan and ignoring CalHAFA. You do not have to do your Dream for All refinance with CalHAFA. But if you don't, we're paying all of these extra fees. So depending upon what your loan to value is, depending upon where rates are, you may or may not be better off, but rarely do I expect that you're going to be better off skipping CalHAFA. So I expect in most cases, CalHAFA is going to be the smarter option. All right, so now let's keep going here. Typical closing costs. So your closing costs, I'm going to project, are going to be 4% of your loan amount. That it's 3 to 4%. And the problem is you've got a few different types of closing costs. So you've got 3 types of closing costs. You've got the hard costs, which is your appraisal, your underwriting, your credit report, title and escrow fees. That's one set of costs. Then you have the points that you pay. Points is what I talked about, saying, hey, you can get a higher rate and less fee because the points become a credit. Or you can buy down your rate and pay a higher amount of fee to get a lower interest rate. So that's the second bucket, is your points. The third bucket is your prepaid fees. If you are including taxes and insurance in your payments, then what's happening is the current mortgage has money sitting there waiting to pay future taxes and insurance. We can't access that money. So I have to put that money into your new mortgage, and then you get a refund check after we complete the transaction. About 30 to 45 days later, you get a refund check back that refunds you the money that was sitting in your old mortgage to pay future taxes and insurance. But I have to have that money in the new mortgage. So typically people are just financing it, billing it in their loan amount. Some people who have the cash, they pay it out of pocket. Okay, but those are the 3 groups of closing costs. We'll be able to go through the closing costs with you more commonly, but between the origination fee, just the first 2 groups, you're looking at, for a traditional loan, maybe 3%. But remember, all those fees I talked about will add to that for the risk. For a Dream for All loan, you're probably looking at about 4% in fees if we're doing it through CalHAFA. But I think the rates are going to be better on CalHAFA, but we'll check every single day. And then when it comes to the prepaid expenses, those really aren't a fee. We're just adding money to the new loan that you're subtracting or getting back later from the old loan. So it's kind of an extra bonus money of cash in your hand, because you're getting a little bit of cash out of the property. You're also typically skipping 1 to 2 months of payments. Now, some people will sell this as a benefit. They might say, oh my gosh, it's a really great deal because you get to skip a couple of monthly payments and that's why you should refinance. That is never a reason to refinance, but it's a fact. The fact is it depends on when we're closing escrow on the refinance as to when the next payment is due and when you made your last payment. Let me give you a really simple example. It is September 1st. If I start right now on a refinance, you'll make your September payment. We'll finish right around the end of September. Your first payment is due November 1st. The payment that was due October 1st, the interest is added as a prepaid expense. So your balance is going up. It is not free money. Do not let lenders tell you it's free money. Your balance went up to cover that interest, but it is skipped money. It is money that, hey, I get to keep a little extra of my paycheck in my pocket because I'm skipping that payment. And if we timed it appropriately, where maybe we started on September 15th and we finished by October 15th, now you made the September 1st payment, but you didn't make the October 1st payment because we're paying it off by October 15th. And because we're doing the new loan in October, your first payment isn't due until December 1st. You get to skip 2 mortgage payments. Now, a lot of people right now will tell you that's a reason to refinance because you can have Christmas money. Your payment only goes down a little bit, but don't worry, we're getting cash out. Even though John King said you can't pull cash out, that CalHFA group says you can't pull cash out. You can, you're just kind of getting it on the slide because you're skipping 2 months of mortgage payments and you're getting a refund of the escrow account. And that could be a few $1,000s in your pocket, but it's not free money. It's being added to your balance and you're burning the one shot you have to refinance without paying off your Dream for All money. So be very, 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 very careful. I'm even more worried about people going out and refinancing these and trying to find the best deal from the cheapest lender. They are out there. There are people that are way cheaper than I am. Not way, but they're cheaper. We are middle of the road, but I think I'm the best. And so you have to choose. You want to go with somebody who's not going to give you really good advice, not understand all of this, and really push you to do something because we're all commissioned. And so they're pushing you to do it because that's how they get paid. And they don't know how they're going to pay for their Christmas gifts for their kids this year. And so they'll convince you should do it so that you can have this extra money to pay for your kids' Christmas. I'm never going to push you to do something that I don't think is the right thing for you. But when I think it's the right thing for you, I'm going to stand on my desk and scream and yell at you saying, hey, do you understand what I'm saying? As soon as you understand, I'll stop and let you decide. Until you understand, I'm not going to let it go because I want you to thoroughly see what I see. And once you do, I've done my job. Then it's your turn to make a decision. All right, let's go ahead and go through some Dream for All specific considerations. Okay, so the first thing is, do we refi to save money monthly or are we looking to save money long-term? With a Dream for All loan, now you say, John, what's the difference? I'm saving money monthly, I'm saving money long-term. No, because with a Dream for All loan, the money you got from the state as the assistance money is very, very expensive. Now, we have a unique market that we're in right now. We've seen market values kind of start coming down a little bit, which is a whole nother piece of this conversation that we're going to get into. But generally speaking, as interest rates start coming down, we expect home values to go up, which means the sooner you pay off Dream for All, the better you are long term. But it often creates the opposite benefit short term. It creates a negative. It increases your monthly payment short term. So you have to decide, what's my goal? Am I comfortable with my monthly payment? If I am, then maybe I should refinance to consolidate the Dream for All money. And here's the thing about refinancing with the Dream for All loan. In the beginning, when you took out the loan, you had rules on how much you could pay out of pocket. The most they would let you pay was 5%. When you're refinancing, no such rules exist. I've already talked to many people who have said, John, I want to put more money into the mortgage. You 100% have the option to do that. And my chart, my spreadsheet is going to show you exactly how that works. And so if that's something that you want to do, we can do that. There are no rules prohibiting you from doing that like there were the first time. Okay, so this is something else that you can consider. So let's go through what the rules are for CalHFA when it comes to refinancing. And bear with me for a second as I pull up my chart that has that in it, because I've been doing so many things this morning that I'm not sure what page. Here we go. I think it's right here. It is. 1 second here as I load that screen. Okay, so this is the part that I didn't know enough about. Okay, I have prided myself in being super knowledgeable about the Dream for All program, and I never saw this. And Cal Haffa never talked about it. I didn't dig deep enough to find it, but it's been there. Let me share it with you. Cal Haffa has rules on when you can do a new refinance and what the rules are for when they'll let you not pay off your Dream for All second mortgage. You can always refinance and combine them both together. You can always sell the house and pay off both of them without any restriction from Cal Haffa, other than paying back the equity, the growth that you have to pay. But Cal Haffa has the right to set rules on when they will allow you to refinance just the first loan and leave the second one by itself. And I didn't know about all these rules until a few weeks ago. So here's what we're looking at, okay? Let's see if I can zoom in on this guy, make it a little bit bigger for you. It's bigger, but maybe too big. Hold on. Come on, John. Scoochy just a little bit. All right, so good enough. I think that's good and nice and big. So Cal Haffa will allow a one-time resubordination. That means that we have your big loan and you have your small loan, and we do a new big loan. Well, the new big loan goes after the small loan, which means that the big one becomes a second mortgage and nobody's going to do a second. And so they have to subordinate or allow the Cal Haffa second to go backwards in line and allow the new first mortgage to be a first mortgage. That's a complicated explanation. Hopefully that made sense. They'll only let you do that once. The simple way to say it, you already have known this, you can only refinance one time without paying back Dream for All money. That's all that says. It must be submitted by a Cal Haffa approved lender. So you have to be working with a lender that is Cal Haffa approved. You do not have to use Cal Haffa's money. We don't have to refinance using Cal Haffa's refi program. I told you already why I think that might be a good idea, but you don't have to refinance using Cal Haffa's refi program, but you do have to use a Cal Haffa approved lender. You only get one chance to do this over the life of the loan. The refinance loan must follow Fannie Mae's guidelines, no big deal. Refinance loans must have a fixed rate. You cannot refinance into an adjustable rate. That's a big one. Because I had some people ask me, John, my bank says they can give me a lower interest rate if it's an adjustable rate. Can I do that and not pay off my Dream for All loan? The answer is no. Cal Haffa says you cannot do that. So the rule right here says no, you cannot do that. Okay. The maximum amount you owe between your current new first mortgage and the second that you have from Dream for All cannot be greater than 105% of the home value. That can be a pretty big issue. Okay, I'll explain that more in detail in a minute. The property must be occupied by at least one borrower. Zoomed out a little bit. One borrower on the deed. Well, that's fine. You knew it had to be owner occupied. That's no big deal. The maturity date, this is a little bit confusing, but this one's easy once you understand it. The maturity date of the first mortgage for refinanced must be less than 10 years in the future. Must be at least 10 years in the future. In other words, if you waited 21 years to do this, and you have less than 10 years left on your first mortgage, you can't do it. You cannot refinance your first mortgage and not pay off the second if you have less than 10 years remaining on the mortgage. Here's the big one. Here's the big one. Borrowers must have made a minimum of consecutive 12 monthly payments on the first mortgage with no late payments. There is a lot built in right there. A lot built into this one. So borrowers must have made a minimum of 12 consecutive monthly payments. So the first thing is, if you haven't had your loan at least a year, you can't refinance, even if you want to, unless you pay off Cal Haffa's second, unless you combine the two loans together into one loan, which Cal Haffa cannot stop you from doing. But if you are trying to refinance just the big loan, and you have had the loan for less than a year, you can't do it. But it's actually even more than a year. It's a year and a couple of months, because your first payment is not the minute you get the house. It's anywhere from 30 to 60 days after you got the keys. So if you got your keys last year on August 15th, you're like, John, I've had my loan for a year. I've made 12 payments. No, you haven't, because your first payment was October 1st. So therefore, you haven't made 12. Well, actually, once you make the September payment, you'll have made 12, right? Because you made October 1st, and then September is the 12th payment. So you're right at that mark. But if you bought in November or you bought in October, your first payment wasn't until December 1st. So you have to be cautious about that date, and they have to all be on time. If you had a single mortgage late payment in that 12-month timeline, first of all, it's going to be very hard to refinance in the first place. Do not ever pay your mortgage late. That is the biggest problem. Credit score matters very, very much, but it's the biggest problem with refinancing and getting any mortgage is having a mortgage late payment. Okay. But what they're saying is, hey, if you have any late payments on your mortgage in the last 12 months, you cannot do the refinance of your big loan and leave your small loan by itself. And more importantly, as I said, for the last time, you have to have made 12 consecutive on-time payments. All right. Next thing, the loan that's being refinanced must have an interest rate at least 0.5% lower than your original mortgage. Well, that's pretty obvious to me. Like, if you can't save 0.5% off of your interest rate, it's not a good idea to do it. Okay. I see a question. Katie says, is the 12-month requirement for refinancing with CalHFA only? No. So no matter who's for the big loan, CalHFA controls whether they will let you subordinate the small one. So if you refinance the whole thing into one new loan, CalHFA has no say in it at all. But if you're saying to CalHFA, hey, knock, knock, I'd like you to let my new loan cut in line in front of you. Picture this like back in the day. Well, I mean, I don't know. You can think about it being in line to get Taylor Swift concert tickets, right? You get into a virtual queue and you're in line. And you got in line and you're waiting your turn to get to the front. Back in the day, back in my day, that was you go to the warehouse and you would, I grew up in the Bay Area, okay, and you would stand in line to go get tickets to whoever the concert was. And maybe it's better thought about like Black Friday, day after Thanksgiving, and you go get in line to get that deal at Best Buy, okay? You are the first person in line. And then you need to go to the bathroom. Well, once you left line, you're technically no longer in line. And so you got to say, hey, no, I need to go home and I need to go take a shower. I'm going to have my sister come and get in line in front instead of me. Well, you got to make sure the people behind you are cool with that because essentially your sister's cutting in line in front of them. Now they're just replacing your spot, but technically they've been in line longer than your sister was. So the mortgage, when you talk about a first mortgage versus a second mortgage, it's about when it was added to title. That's it, not size, but date. So your first mortgage was added 1 minute before the second mortgage was. That makes the small CalHFA loan a second mortgage. When we pay off the first mortgage and we do a new one without paying off the CalHFA second mortgage, that second mortgage becomes the first and the new loan becomes the second. So Katie, no lender is going to let you do that if they're going to be in second lien position. So they need to get permission from CalHFA to cut in line in front of them. So no matter who we do the loan with on the first mortgage, CalHFA controls letting that first mortgage cut in line. And this rule sheet that we're looking at is CalHFA's resubordination policy. It's not their refinance policy because this applies whether they are doing the refinance or somebody else. It's their resubordination policy. So you have to follow this. Even if you refinance with someone else, you have to have made 12 monthly payments on time in order to do it. So hopefully that helps answer the question. I wish I had known this sooner. Not that I think it would have changed anything for anybody, but I certainly would have talked about it a lot more often had I known. I just found out about it a few weeks ago. All right. You have to be at least 0.5% lower in interest rate. Again, I'm worried about you refinancing too early. 0.5% is not enough savings. You have to have at least $50 in savings for your principal, interest, taxes, and insurance. Well, if you're only saving $50 a month, do not do this. Like, don't do this. Don't let somebody convince you to do that. But technically, it's a rule. Okay. No additional liens may have been taken out. You can't take out a second mortgage or a third or anything else. If you have a PACE or a HERO loan, if you don't know what that is, no big deal. But if you have one, it has to be paid off. And they charge a $400 fee that gets paid up front. So as we are going through the refinance process, this is all about timing. This is all about the process that we're going to go through. And I'm going to get into that in just a second. Okay. But it's about timing on when we do things. I'm an expert in the timing and I'll help guide you through all of that. All right. So here's the deal. You're going to have 3 paths to choose from. The first path is refinance as soon as you can in order to reduce your monthly payment. We'll get to my spreadsheet in just a second. I'll share that to you. The second path is to combine both loans together, and it'll save you the most amount of money long term. The third path is do nothing right now and wait and hope. So even when you can refinance, see where I said right here, can I refi? It's whether you should refinance. Remember, if you didn't catch the beginning, can I refi? The QR code works perfectly. Right now, I just messed up on how I set it up in GoDaddy. So you have to type www.canirefi.com to get to that page. So if you type can I refi, it won't work. You type www.canirefi, it'll work perfectly. Okay, so can I refi is one thing. Should I refi is the other thing. Okay, so you might just say, you know what? Yeah, the numbers I can, but I think I'm better off waiting. Okay, so let's review my calculator. So let's pull up the calculator and have you guys take a look here. So you will get a copy of this calculator. Just set up a meeting with me. And I can create this calculator and I'll send you a copy of it. Okay, so you can set up the meeting by clicking on the QR code up there or going to www.canirefi and setting up an appointment that way. All right, here is my calculator. Let's get rid of the banner. Bye-bye banner. Okay, and let's make me smaller and that bigger. Let's see here. Hold on. Come on, computer. Which one do I want? I want this one. There you go. All right. So what you are looking at here is a spreadsheet. I'm going to zoom in even more so that you can see what I'm doing here. So you're going to type in when you originally purchased the house, what was the purchase price? You're going to put in your closing date. You're going to put in your first mortgage balance. This is somebody who bought last year. They bought a house for $750,000. They got exactly the loan amount for $600,000. Their rate at that time was 6.625. This asks, were you considered low income at the time you purchased the home? Now, you may not know that, but your lender should have talked to you about it. You got a little bit lower interest rate because you were low income. You'd probably know it. If you don't think you were low income or you don't know what that means, then the answer is no. Okay. And then we're going to guess on your first payment date. But if you know exactly when your first payment was due, we'll put it in here. Okay. Now we only have to fill in 4 more things, which is what was your estimated market value? What is it now? What do you think the house is worth today? So in this case, hey, we bought it for $750,000. We think it's worth $775,000 right now. And then what are current interest rates? Well, that's where we're going as an example to Cal Hafa's page. And we're pulling up what Cal Hafa's interest rate is. And we'll see right here, Cal Hafa's refinance is 6.375. So that's what I would put right here. And then do you want to build the fees into your new loan? That's yes or no. Okay, you have a choice. You can pay the fees out of your pocket or you can build them into the loan. And then do you want to pay extra towards your balance? You have some extra money sitting there that you want to use to pay down your balance. The rest of these numbers are calculated, but you can change them if you think they're wrong. So I calculated your exact mortgage payment, principal, and interest. That should be right if you put in the numbers up above. Your current first mortgage balance, unless you've been paying extra, that number is right because it's calculated based on the amortization table, how much you're paying down. So that's your balance. Your closing costs, I'm calling it 4%. And then your new loan, you're typically doing a new 30-year loan, okay? With that information in here, it comes up with all the numbers. And it says, okay, well, you're going to drop from 6.625 to 6.375. So the first thing, if we scroll all the way down, there are 4 requirements right here that I forgot to put in a little tab, a little, what do you want to call it? Borders. So I've got a question. Let me grab the question really quick. Okay, Martino, I'll cover that in a couple minutes. All right, so you've got, right now it's telling us, do we meet the rules? So you must have had 12 on-time payments. Well, I'm assuming on time, but it looks like we're at 12 months, so it's good. You can't borrow within 105%. That looks correct. Your new rate needs to be at least 0.5% lower than the current rate. Nope, that's false. You're not saving enough. Your payment must be at least $50 lower than your current payment. Nope, because it's only saving you $14 a month. You're saying, John, how if I'm saving 0.25% off my rate, am I only saving $14 a month? Because your balance went up. You're paying fees. Your current balance is $593, but right here, I'm ballparking the closing costs at $24,000. Now, there's ways to make it smaller, but the truth is you're not going to. Because with a Dream for All loan, you have to pay that extra fee that goes along with having a subordination. So it's going to cost you more to do that loan. So I think this is a pretty realistic number. So your balance is going from $593 to $618. So you're adding $24,000. That's why it's not saving you any money per month. And so now if I zoom, by the way, second option over here, scenario B, says, well, what if I just put it all together into one loan? All right, well, your value's gone up by 25 grand, so you owe Cal half an extra 5 grand. So therefore you have to pay him back $155,000, which means your new loan needs to be about $748,000 plus the closing costs. So you're going to owe $780,000. Actually, I take that back. This isn't even including the closing costs yet, is it? It's not. So that's just your new loan amount before we add the closing costs. So we're just adding no, hold on. Yeah, this includes the fees. I'm pretty sure. I don't know. I've just created this. I apologize. I'll look at it again. But basically what this says is, hey, here's your scenarios. Now you're only saving 0.25%. This is not a good idea to do it. But this gives you an idea right now saying, hey, do you meet the requirements? No. Are you saving any money? No. But here's the coolest part of my spreadsheet right over here. It tells you what your payment savings are as interest rate drops. So it starts with whatever interest rate you typed in. And so if you said, hey, today interest rates are at 6%, okay, then as I go back over here, it's going to automatically start at 6%. And it's going to say, well, yeah, at 6%, I'm saving $135. That matches what I've got right over here in the middle. I'm saving $135 a month. I'm not sure if that's good enough or not. I'm saving at least the $50. I'm saving at least 0.5% off my interest rate. So technically I can do it, but is this really a good idea? And so I'm looking at this and saying, well, if I wait for rates to fall to 5%, I'm going to save $523. That's the power of this spreadsheet. Now, you don't know when it's going to hit 5%. You don't know if it's ever going to hit 5%. And you could get super greedy and say, yeah, John, 5% is great. But at 4%, it saves me $900 a month. I'm going to wait until I get to 4%. But you're wasting money in the meantime. And it may never get there. And so there's a point where you have to say, you know what? The savings are worth it now. But once you pull the trigger to lock in those savings, the next time you refinance, you have to combine everything together. Which means, now here's the cool thing, in this scenario that we're looking at right here, it says, hey, I can refinance at 5% and save me $523 a month. And then when rates hit 4, I can combine everything together and still, and now the problem is your payment's going to go $119 cheaper than it is today, but you save yourself $523, which means your payment's going to go up by $400. I know that might be too much, too fast, but I want you to understand, if you take on this refinance, you're locking in the savings now, but now your payment's $500 cheaper. Instead of $3,700, it's $3,200. But if rates then fall to 4%, you want to say, okay, I want to refinance now at 4%. You have to combine the two loans together. And your payment for the two loans together is going to be $119 cheaper than your payment today, not cheaper than what your new payment's going to be. Okay, because I'm not comparing this to what your new payment's going to be. Maybe I can put that in there to give you a better idea. But that means that your payment's actually going up by about $400 a month. It's going to be around $3,580 a month. So you've got to say, hey, once I refinance to lock in these savings, even if rates fall by another 1%, I'm not saving any money. My payment's going to bump back up. And so you've got to be very thoughtful about this. Now, for some people, your monthly payment is super tight right now. And John, I need as much savings as I can get. I get it. But I'm worried about you refinancing too soon. Now, I don't get paid unless you refinance. If you're going to refinance with somebody, I want it to be me. But I'm going to tell you that you have to be thoughtful about this because you get one get out of jail free card. This is the hardest decision of anything you are doing regarding Dream for All and using this program is when do you pull the trigger on refinancing? Because if you pull the trigger too soon, you lock in those savings now, but if you want to refinance again, you have to pay back the state. I'm probably going to add a third scenario here, which is if you do scenario A and then jump to scenario B, how much that's gonna cost you. I'm not sure if I can mathematically work that out as easily as I'd like. But the bottom line is, be very careful, because somebody's going to push you to say, oh my gosh, this monthly payment savings is worth it. You should do it. You should do it. You should do it. And maybe you should. Maybe you should. At some point you should, but you got to be really cautious and say, what's it going to mean for me long term? Because it locks me out of refinancing and saving even more money later. If I postponed and I waited and I did nothing, I could refinance once we get to 4.25%, and I'd have the exact same payment I have today. And for some people, that is the right way to go. Now, there's other people that are saying, no, John, I have some money to put into this. I have $50,000 that I want to put into this. Well, that changes the numbers a lot. Now, oh, my calculator's not working perfectly. Well, this one is, that one's not, I don't know why. Okay, now it is $447. So you're saving, by putting in 50 grand, you're saving $447 at a 6% interest rate. Okay. If you put in 50 grand, you might say, John, I'm okay with having a little bit higher monthly payment. As a matter of fact, I've got some money I wanted to put in 125 grand extra. I just couldn't. Okay. So now you put in that extra 125 grand, you can refinance and keep the exact same payment you have today and just pay off the state. So there's lots of ways we can look at this. Lots of things that you can do. Or you can say, you know what? I'm going to refinance. I'm going to put 125 grand into this, and I'm going to save my $1,000 a month, because that's really important to me to save $1,000 a month. There are many ways you can set this up. I am an expert in them. I want to help guide you through this, and it is not as straightforward as you would like to think. All right, Martino had a question. He said, how long do you have to be in the area median income to be considered low income? It is what I calculate your income to be at the time that you do the loan. And if at that moment you are beneath the area median income limit for the area that you're buying, you're considered to be low income. Okay, so that's all that really matters. So at the time that you take out the Dream for All loan, if you're considered low income, then you get the lower interest rate, and you only pay back 3/4 of the appreciation percentage. In other words, instead of paying back 20% of the increase, you pay back 15% of the increase. So hopefully that makes sense and answers your question. All right, so we reviewed the calculator. I'm going to wrap up with some questions that I've got that people have asked me, and then I'm going to talk about the next steps and how the process is going to work, and then I'll leave time for questions. If you have questions, ask at any point in time, because by the time I get to the Q&A at the end, if nobody has questions right then, I'm gonna sign off. So if you have questions, now is a good time to start asking them, because I'm going through common questions. So the first thing is, you have an appraisal risk. What if my home values dropped? So first of all, you only owe CalHFA the 20% of what the price has gone up. If the price has not gone up, you don't owe CalHFA any appreciation, but you still owe them the full amount that you loaned to them. So I'm going to share my screen again, and I'm going to show you what that looks like. So here we go. And so let's look at this same scenario, except let's pretend the house price has dropped. So we're not putting anything extra towards the loan. And we bought the house for $750,000, and now homes are selling for $700,000. Okay. I hope that isn't going to happen. I don't think we're going to have that significant of a price drop, but we are in a time where prices are starting to come down a little bit. So that is something that we need to be nervous about. In this case, your balance is $600,000. You're like, well, John, that's well below 105%. But we have to add in the second. You have a second of $150,000. And so when I look at that, your loan to value, how much you're going to owe on the new first mortgage, including the fees, plus how much you owe on the second mortgage, which is your $150,000 that you took out right here from CalHFA, the total that you owe is 109% of the $700,000 value, which means you are no longer meeting the rule of maximum of 105%. Now, you can pay some money out of pocket, but technically, when we look at this, we look at the fact that, hey, you don't meet the refi requirements. I don't know why that says true. I got to double check that, because one of these is false. So that is not good. All right. Anyway, it's an imperfect spreadsheet. I'm still playing with it. All right. So in this case, you'd say, all right, well, I don't want to build my fees into the loan. And now if I don't build my fees into the loan, I'm coming out of pocket with the fees of $24,000. but now I'm borrowing, I'm still not there. I'm borrowing $106,000. Maybe I need to put an extra $5,000 out of it. I don't know. I got to run the exact math. Okay, I'm totally guessing right here. But at some point, as you're putting more money, now we're at 105.5. So if I put an extra $8,000 out of pocket, now I'm still a little too high, 105.06. We'll just call it 10 grand. I think you guys understand the point is that if I can put $33,000 out of pocket, then now I'm okay because now I'm borrowing less than 105% of the value of the home. But we are in a market right now where there are not as many buyers as there have been, and there's a lot more sellers than there have been. And interest rates have not dropped enough yet to bring more buyers back into the market. And there's people that are nervous about their job. There's people that are nervous about the economy, and it's causing house prices to start to drop some. And so that is a concern when it comes to refinancing. And that is a concern for people who already borrowed 105%. For a lot of my clients getting into this, they wanted to figure out, how do I get into the house, John? And I don't have very much money out of pocket and I want to be a homeowner. And we accomplished that goal. We loaned you 105% of the home value from the start because we took 5% of the money that was going towards your down payment and we put it towards closing costs. And then we took the money that was going towards that down payment money is now only 15% down. Yet the Dream for All money was 20. So you borrowed 105% already. So if your home value drops at all, you're in trouble. As a matter of fact, you're already partially in trouble if your home value hasn't gone up, because it has to go up enough to also include the fees, or you're having to pay the fees out of your pocket. So there's a lot of moving parts here that come into play, and I'm an expert in helping you understand and navigate through them. All right, what's the next question I get a lot? Where are rates going and when will they drop? It's a great question. I don't have an answer. What I'll tell you is the Federal Reserve does not control mortgage rates. Okay, when you look at mortgage rates, you've all been watching the rates. You've seen rates drop this year. Okay, in January, Cal Halfa's Dream for All rates were over 7%. Okay, I had a client who locked in at 7.375. I had a few of them right at the same time. And I think it was January, February. And though that was the highest rate that I saw on the Dream for All program. And just like when I was telling those people at that time, I don't know if it's going to go higher tomorrow or not, but we have to make a decision. And we did. Now with refinancing, you don't have the same window of I have to decide in the next 2 weeks because I have a purchase contract. When you're buying, you had to lock because you had to close escrow by a certain date. On a refinance, you don't have to lock. You do at some point. But you have the lock conversation is even harder on a refinance because you can wait a week, a month, 6 months. It's no big deal. It's just about when are you going to pull the trigger. Okay, the Kenny Rogers song, got no one to hold them, no one to fold them, no one to walk away, and no one to run. Okay, a lot of you probably don't know that song. But you've got to know, hey, I've won enough that I'm going to take my chips off the table. I'm going to go ahead and lock it in and not think about it any longer. That is going to be a hard decision to make. But the truth is, you saw interest rates grow from 7.375 and now they're at 6.375. Rates have fallen a full 1% since the beginning of 2025. Yet the Federal Reserve hasn't lowered rates once in that time frame. So get it out of your head that the Federal Reserve is controlling rates, and that next month, later this month, the Fed's likely to drop rates by a quarter. There's a chance they're going to drop them by a half, and everybody's convinced that mortgage rates are going to fall by a quarter to 0.5% because the Fed's going to lower them. The Fed doesn't control mortgage rates. If they did, rates would not have changed all year because the Fed has not changed rates all year. Think about that. So no, the Fed does not control mortgage rates. The Fed controls rates that are banks borrowing money for 1 day. It is the shortest duration of a loan. But the Fed decides their rates based on the economy. So does the mortgage market. And so typically the direction the Fed is going is the direction the mortgage market is going, but there's times when they diverge. So we don't know where rates are going, but there is they've dropped a good amount. There's a good chance they will continue going down, but how quickly, we don't know. Last year, we saw mortgage rates drop significantly in August and September. We saw them go from October of 2023 through August and September of 2024. They were at the high of 8.5, and they fall all the way down to 6.5. Okay, significantly bigger drop than we've seen in the last 12 months. But as soon as the Fed started lowering interest rates, mortgage rates shot up again. They went from 6.5 up to about 7.25 to 7.5. Okay, so it's a volatile environment. Do not buy into the fact that when the Fed lowers rates, mortgage rates will go down. They are not controlling the mortgage rates. So we need to just pay attention. Every single Friday, I put out a live stream where I'm talking about the market and what's happening with interest rates and where I think things are at and where I think they're going. I'm guessing, but I feel pretty educated in the guesses that I'm making, and that's going to be my way to guide you through this process. All right, a couple of these we talked about already. Do I start over for 30 years? You can. A lot of people do. Most people do, but you don't have to. I think CalHFA, if we do the refinance through CalHFA, I think we have to do a new 30-year. If we do it separate from CalHFA, I have lots of options to not do it as a new 30-year. Okay. So the next thing is, can I pay down extra? Am I limited to 5%? I already covered that. You can pay down as much as you want. So we can have that conversation. I've heard that you can skip 2 payments when you refinance. I talked about that already as well. So yes, you can, but it's not free money. All right. So let's talk about next steps. So first and foremost, scan the QR code up here, schedule a call with me, or start the application process. We do not have to pull the trigger to lock a rate at the moment you start the process, but it gets a loan application in my system. That is the single most important thing you can do to be ready when rates do fall. Because when rates fall, they sometimes fall for a couple of days and shoot back up. And so I'm going to start with the people who have already given me their information, people who have already updated their loan application, already updated their paycheck stubs and W-2s. And maybe we update all that, and it's not until 6 months from now that we're going to lock the interest rate. But at least I've gotten it updated and you've committed, John, I'm willing to give you this information. And it makes it easier for me to go in and press the button because everything is there ready and waiting. Sometimes we just need to lock right away because the rates fell pretty significantly, pretty quickly. So be aware of that fact. When you are refinancing, you have a couple of considerations you have to choose. You have to choose when you lock. You have to choose when you order the appraisal. They don't have to be done at the same time. If we think that values are dropping, we want to order the appraisal as soon as possible. The problem is that appraisal is only good for 4 months. So from the day we get the appraiser out to your home to the day that you complete the refinance can only be 4 months. It can't be any longer. That appraisal is wasted, and you've wasted $750 paying for that because you're paying for the appraisal at the time that we order it. But for some people, they're saying, John, I know I'm going to refinance really soon. I want to know the value of the property, and I want to wait until the interest rate falls just enough. So that's not a problem. We can 100% do that. Okay. But you've also got to realize that if you order that appraisal and it waits longer than 4 months, that appraisal is wasted. Okay. The rest of the process, once we're moving forward, is the same as what you went through when you bought the home. We're going to update your income. We're going to look at your credit report. Credit score matters. Okay. CalHFA has the same credit score rules if we use them. And I like CalHFA's rules in that everybody gets the same rate, regardless of your credit score, as long as you've got at least a 680 credit score or 660 if you're low income today. Now, I say low income today because you might have been low income when you bought the home, but you've gotten a pay raise and now you're no longer low income, then you don't qualify under the low income program for the refinance. As Martino asked a little bit ago, the low income is at the time that you complete the loan. So whether that was on your original Dream for All or on the refinance, what is your income level compared to what the rules are for your market, for where you're living? So there's some moving parts there that you got to pay attention to, but everybody gets the same interest rate, regardless of their credit score if we go with Dream for All. If we go on the open market, you saw me show that chart earlier that showed all of the different scenarios of if my credit score is this and my equity is that, this is what you're adding an extra fee. And so if you have great credit and great equity, you're better off not doing the Dream for All. But if you don't have great credit and or you haven't built up a lot of equity, you might be better off going with the Dream for All scenario. Okay, got a question. Dre asks, are there any early payment penalties? No. There's no prepayment penalties on any conventional loan. So when you did the Dream for All loan, it was a conventional loan. When you are doing a new loan right now to refinance it, we're doing a conventional loan. So you have no prepayment penalty, you have no early payoff penalty. Just recognize when you pay off the Dream for All loan, you're paying back not just what they loaned you, but the equivalent percentage of how much the house has gone up. For most of you, that's 20% of the increase in value that you are paying. Okay. All right. By the way, guys, now is the time if you have more questions to post them. If you're watching recorded, you can post them and I'll catch them later. If you're watching live, now would be the time to post them. Back to next steps. All right. So the next step, scan this QR code. Again, by the time you're watching this recorded, this will be fixed, but can I refi? The link doesn't work directly. You can type in www.canirefi and it'll take you to the page, or scan this QR code. So www.canirefi.com, or scan the QR code and it will take you to my page for refinancing. I'm building out that page and adding more information so you can check back to it later. But if you want to get a copy of this spreadsheet, then we're going to sit down together over a Zoom call and we're going to talk about your scenario. It'll take 15 minutes. I'll put the information in. I'll send you a copy of the spreadsheet and I'll help you to understand what your options are. And at that point, it's entirely up to you. Here's the final thing I'll tell you. I don't think anybody should be refinancing the Dream for All loan right now. I think there's a few people who are really, A, they had a loan at the high end of where rates were, and B, they're kind of tight in their monthly payments, and or they have extra money they want to put towards it and pay down the balance, so they're paying less interest on a smaller balance. Those are about the only reasons I think it makes sense, okay? I think we need to watch interest rates. Once they start hitting into the fives, it may make sense, but really we need to go through this analysis. You need to schedule the appointment with me, scanning the QR code or typing in www.canirefi.com and click on schedule an appointment, and let's have a conversation and go through all of your options. I will help guide you, but guys, this is a guessing game. I don't know where interest rates are going every single day. I didn't expect last year for rates to go up as quickly as they did once the Fed started lowering rates in September. I don't think that's going to happen again this year, but I don't know. And so the unknown is we might have the best rates right now that we're going to see for the next 2 years, or they might be going a lot lower, a lot faster than anybody expects. We honestly don't know. We just have to read the tea leaves and be ready to pull the trigger when the numbers make sense. And it starts with us having a conversation now to get your numbers lined up, to figure out what your situation is, to talk about your goals, long-term and short-term. And by the way, never refinance a home if you're planning on selling it within a year. Never. It never makes sense. You never recuperate the money. As a matter of fact, most of the time, you need to plan on staying there for at least 2 years before it makes sense, because you have fees you're investing up front. Even if you're not paying them out of pocket, you have fees that are being added up front, and there is a break-even point, and I'll go over the break-even point with you. So it's really important for you to understand that, and it's really important for you to let me guide you through that. Okay, you guys have been listening to me for hopefully over a year or longer. You've hopefully built up some trust in me that I'm here to guide you. This is the hardest part, deciding when to do it. And I hate to say it, but there are so many people in my industry right now who are struggling. The mortgage world and the real estate world has collapsed because interest rates have skyrocketed, and a lot of people in my industry have left the industry. The ones that are left, a lot of them are struggling right now. By the way, I'm filling in, so if you have questions, now is the time to type them, because after I finish my monologue here, if there's no questions, I'm signing off. So there's a lot of people in my industry right now who are struggling, and they are literally hanging on by a thread, and they will do anything to get another paycheck. And I can certainly respect and understand where they're coming from. I have built a very, very strong business. I built a referral-based business. I've got a lot of you that trust me and are coming to me. It's just the truth. I don't need any one loan to pay my mortgage, okay? So I am telling you the advice based upon what I think is best for you, not based on whether I can get a paycheck tomorrow. And many of my peers can't say that. And so you're in a position where you've got to trust somebody to say, hey, should I do this? Does it make sense? And that person has to be able to separate their needs from yours and give you the best advice. And I promise you that I'm that person to make that happen for you. I am for sure interviewing for the job to be your lender. If you haven't gotten your Dream for All loan yet, I am here to help you. Whether you have a voucher, whether you're trying to get in for next year, or you already got your Dream for All loan, and now you're trying to figure out, how do I save money? That is the scariest, most challenging decision: when to refinance, how to structure the loan. All of it has significant implications, and I've hopefully given you a lot of good information in the last hour, and I promise you that I will help guide you through this process going forward. Please give me the opportunity to help you make that happen. Does not look like I have any questions. So guys and gals, I really appreciate everybody joining me today. Please reach out if you have any questions. Schedule that appointment, scan the QR code, or go to www.canirefi.com. Schedule an appointment with me. You can start the application process. Post questions here if you have them in the future, and I look forward to guiding you. Hope everybody has an absolutely wonderful holiday, and we'll talk to y'all soon. Bye-bye.